So you want to own a casino. Big building, flashing lights, thousands of people walking in every night and voluntarily handing your money. Sounds like the easiest business in the world. It is not. The story of how casinos actually make money and how they actually lose it is one of the strangest stories in business because almost everything you assume about this industry is wrong. Let's start with the price of admission. A single slot machine license, a state gaming license, a building built to code with reinforced floors for the weight of thousands of machines, surveillance systems with thousands of cameras, cash handling infrastructure, and a security apparatus that rivals a small airport. Before a single card gets dealt, you can be looking at hundreds of millions of dollars. Building a large resort casino from the ground up in a major market can run well past $1 billion once you add hotel towers, restaurants, and entertainment venues. The land alone, if it's anywhere near a population center, can cost tens of millions of dollars before you pour a single foundation. And here's the first thing nobody tells you. The license is often worth more than the building. In states with limited gaming licenses, that piece of paper allowing you to legally operate can be the single most valuable asset in the entire deal, sometimes worth hundreds of millions of dollars on its own, completely separate from the real estate. You're not just buying a casino, you're buying permission. Not all casinos are the same casino either. There's a massive gap between what the industry calls destination resorts and everything below them. A destination resort has a recognizable brand, a location people fly in for, high-end restaurants, headline entertainment, and a hotel that's booked out most of the year. These properties can generate over $1 billion in annual revenue and trade for tens of billions.
Then there are the regional casinos, smaller buildings tucked off a highway exit, dependent almost entirely on local, repeat customers within a 50-mile radius. Some of these properties have changed hands for a tiny fraction of what it cost to build them. Atlantic City alone lost 5 casinos between 2014 and 2016, including the Revel, a $2.4 billion property that opened in 2012 and filed for bankruptcy within a year, eventually selling for around $200 million, less than a tenth of what it cost to build. So here's the first lesson. You're not really buying a casino, you're buying a bet on a location and a customer base staying loyal. Most large casino companies, by the way, don't own their buildings the way you'd assume. Many operate through a real estate investment trust structure, where a separate company owns the physical property and the casino operator pays rent to use it, almost like a retail tenant. This split lets operators raise capital without owning the underlying real estate outright, and it means the person collecting your slot machine losses at 2 a.m. might not even be the one who owns the walls around you. Before you make a dollar, there's a layer of costs that catches almost every new owner off guard. First, gaming taxes. Depending on the state, you can be handing over anywhere from single digits up to over 50% of gross gaming revenue straight to the government before you've paid a single employee or turned on a single light. Second, regulatory compliance costs are enormous and constant. Background checks on every employee, audited cash controls, and inspections that never really stop. Third, and this is the one nobody pictures, the hold isn't guaranteed. Every casino has a theoretical house edge, but on any given month, a run of bad luck on high-stakes tables can wipe out a shocking share of expected profit. Whales, the term for ultra-high-stakes gamblers, can single-handedly swing a casino's quarterly earnings up or down by tens of millions of dollars, depending on whether the cards fall their way.
Now here's where it gets interesting, because the way a casino actually makes money is far more layered than people assume. The first and most obvious layer is the games themselves, slots and table games. Slot machines are the real backbone of the business. In most American casinos, slots generate somewhere between 65 and 80% of total gaming revenue, far more than blackjack, poker, or roulette combined. That's because slots have a built-in house edge that's both consistent and, crucially, largely invisible to the player, who's mostly focused on the flashing lights in the next spin. Before we go further, if you're finding the way these numbers connect together interesting, that's the exact kind of pattern this channel digs into every week, so it's worth hitting subscribe now so you don't miss the next one. All right, back to the casino floor.
The second layer is comps, free rooms, free meals, free show tickets. This looks like generosity. It is actually one of the most calculated parts of the entire business. Casinos track player spending through loyalty cards down to the exact dollar, and they calculate exactly how much theoretical loss a player represents before deciding how much free stuff to give back. A guest who's expected to lose $2,000 over a weekend might get a free room worth $300 because the casino has already run the math and knows, on average, that trade heavily favors the house. The third layer is the hotel and food and beverage side, which for a long time was treated as almost a loss leader, a reason to keep people on property longer, closer to the machines. But at destination resorts, non-gaming revenue has grown so large that at some major Las Vegas Strip properties, it now makes up more than half of total revenue, sometimes significantly more, coming from hotel rooms, nightclubs, restaurants, and retail, rather than gambling itself. That's a complete reversal from how the business worked decades ago, and it's reshaping how new casinos are even designed. Here's a counterintuitive detail hiding inside all of this. The games with the worst odds for players, like slot machines, take up the most floor space, while the games sophisticated gamblers actually prefer, like blackjack with skilled play, take up comparatively little. Floor space, like everything else in this business, is allocated according to house edge, not player preference. So far, this sounds like a machine that prints money in 5 directions at once. Now, here's the other side of the ledger. Payroll is enormous. Dealers, security, surveillance staff, hospitality workers, and a management layer that runs around the clock every single day of the year, since a casino floor never truly closes. Utilities on a resort-sized property, lit up and climate-controlled 24 hours a day, are staggering. Add property tax, insurance, marketing budgets that can run into the tens of millions to keep filling those hotel rooms, and constant capital reinvestment, because a casino floor that looks dated loses customers to the newer property down the road faster than almost any other business. And here's the trap almost nobody sees coming until they're in it. Even a mostly full casino can lose money if the customer mix is wrong. A property might look packed on a Saturday night and feel wildly successful. But if a large share of that traffic is low-margin slot players pulled in by expensive marketing promotions, and comps are being handed out faster than theoretical losses justify, the actual profit can be far thinner than the crowd suggests. A full floor is not the same thing as a profitable one. It's worth understanding something the industry figured out decades ago because it explains the shape of every casino you've ever walked into. Casino design pioneers, working with behavioral researchers, discovered that removing clocks and windows kept players from tracking time. They found that low ceilings over slot areas felt cozy and encouraged longer sessions, while soaring ceilings over table games created a sense of importance and excitement. They designed maze-like floor layouts so that walking from the entrance to anywhere else meant passing hundreds of machines along the way. None of this is decoration. Every inch is engineered to maximize the time and money that passes across that floor. Now here's the structural risk running through the entire industry, and it's best explained through what actually happened in Atlantic City. For most of the 20th century, Atlantic City thrived as the only legal gambling destination on the East Coast outside Nevada. But starting in the 2000s, neighboring states legalized their own casinos, and Atlantic City's customer base, people who used to drive hours to gamble there, suddenly had options 15 minutes from home. Revenue collapsed by roughly half over the following decade. 5 casinos shut down within a 2-year span, throwing thousands out of work almost overnight. That's the structural truth underneath the whole industry. A casino doesn't fail because gambling stops being popular. It fails because its one real advantage, being the only option in the area, disappears the moment a competitor opens closer to the customer. To understand how this plays out, look at one real property from opening to closure. The Revel in Atlantic City opened in 2012 as a $2.4 billion non-smoking luxury resort meant to redefine the market.
It filed for bankruptcy within a year of opening. It filed again the following year. By 2014, it had shut its doors completely, less than 2.5 years after opening, eventually selling for roughly a tenth of its construction cost. The building didn't fail because it was ugly or poorly run. It failed because it launched directly into a market that was already losing customers from nearby competition, with debt payments that assumed a customer base that had already started disappearing.
None of this happened in a vacuum. It happened at the same time online gambling and sports betting were expanding rapidly across the country, giving people a way to gamble from their couch that didn't exist a generation ago. This is why the properties that struggled most were often the ones stuck in the middle, not upscale enough to sell an experience people couldn't replicate online, and not conveniently located enough to win purely on proximity. The casinos that survived responded by changing what they sell. Instead of leaning purely on the gaming floor, many properties expanded into things a phone screen genuinely cannot replace: nightclubs, concert venues, celebrity restaurants, spas, and shopping. The idea is simple, even if it's expensive to execute. A casino used to sell the game itself. The ones still standing sell an entire night out that happens to include a game. So does owning a casino actually work as a business? It depends entirely which casino, and the gap between the good outcome and the bad outcome is enormous. In the optimistic scenario, you own a well-located destination property with a strong brand, diversified revenue across gaming, hotel, and entertainment, and little nearby competition. Slot revenue, table game hold, comped but profitable high rollers, and a full hotel together produce steady, predictable income, with property values climbing as the market grows around you. This is the outcome that built some of the largest entertainment companies on the stock market. In the realistic bad scenario, a competitor opens closer to your customer base. Your marquee gamblers start splitting their trips elsewhere. Marketing costs rise just to maintain the same foot traffic. Comps eat further into margin, and debt payments stay fixed no matter how the floor performs. The building doesn't change, the economics underneath it do. A casino looks, from the outside, like a building full of games. From the inside, it's a single, tightly engineered system where lighting, layout, and loyalty programs all point to one outcome, and where the house edge only means something if the doors stay full. The games don't run the business, the traffic through the door does, and the moment that traffic finds somewhere closer to go, the odds stop being the only thing working against you.